Boy, that's taking a couple of seconds. Here we go. Here we go. Hey there, it's Mitch Goldberg. Welcome to Be the Boss of Your Money. This is your post-market show all about personal finance, investing, what's going on in the world economy, the stock market. There is so much news. It's making my head spin. Yeah, I can't spin my head. But we're going to talk about these things. And I want to talk to you about the basic advice that I had with some clients over the last 2 weeks. I think it makes a lot of sense, and I think it's worthwhile sharing with you. Listen, my content, my best content, comes from conversations that I actually have with real clients. I've been doing this for almost 32 years. So I've had a lot of conversations. I've seen clients overcome challenges, not overcome challenges. I've made mistakes. I've done things right, and I've learned a lot. And that's what you go through. That's what makes it a career, right? So we're going to talk about that. My name is Mitch Goldberg. You're watching Be the Boss of Your Money. If you have any questions, please hit me up in the comments below. I'd love to see what you're asking, and I love your participation. It means a lot to me. Words of encouragement, words of advice are always appreciated. And let's get going with the quick intro, and then we're going to get into it. It's going to be a good show today. Let's try that one more time. All right, screw it. I hate when the intro doesn't work the way it should, so I'm just going to have to put up a quick banner here. Let's see. All right, I already have the banner I want, and that's that. Okay, no big deal. So I'm going to run the intro. I'm supposed to run an intro, and that really sucks when it doesn't work. But I see some people out there already, so thank you for watching. We're talking about... All right, I'm going to have to call StreamYard and see what the deal is with that. So let's talk about a couple of things. Today, we started with a rally, a continuation from last week's weekend rally. I'm not saying a weekend rally. I'm saying a rally into the week's end. Market recovered nicely from that pounding it took last Monday. It's hard to believe that just a week ago, the stock market hit the skids, down over 600 points in a day, but it was down almost 1,000 earlier in the day last Monday, and people thought, that's it. It's lights out. The bull market is over. We've got to get out. Then we turn around and we recover right back up. And a lot of people are saying, like Mohammed El Arian, commentator on CNBC, says this is a liquidity driven market, and I follow him closely. I have a lot of respect for him, but I've also realized that when I watch him, it's always like, yeah, but we're not out of the woods yet. Yeah, but the economy has some big hurdles. Yeah, the market has some big hurdles. We've got to get past this Fed announcement, the employment report. We've got to see this. We've got to see that. I think you should not be listen, I can't tell what other people to do. I can only control what I can do. But as a long-term investor and advising clients who are long-term investors, what I don't want to do is get into the constant, yeah, but we're not out of the woods yet. We are never going to be out of the woods. That's what the stock market is all about. That's what makes it a risky proposition. That's where your growth comes from. If it wasn't for the risk, you wouldn't have the returns. At the end of the day, ultimately, when you invest in a company, in a stock, it is representative of the efforts of the management of the company. And a company that is managed by people who are motivated to make more money, to grow the business, to hit certain metrics. Some of them are experienced managers with Wall Street, and they know what Wall Street's looking for. and they run a business to please Wall Street in some way or another for the numbers so that Wall Street likes the stock and sends the stock up. But even before that, you still have to have a company that serves its customers, that does something unique. You don't have to be original for everything. You could take an old business and just reinvent the way it works, the way it functions. I say just like it's nothing, but we know it's harder said than done. Take a look at Amazon. Amazon was a bookseller. And I remember all the arguments against Amazon, late 90s, early 2000s. There's no money to be made in books. Books is a low margin business. You already have B. Dalton bookstores, you have Barnes and Noble, and lots of other bookstores. Why do we need an online bookseller? Well, it actually worked. It was just a simple thing, buying books, but people prefer to buy their books online than in a store. And it didn't take a lot. Amazon was a small company. They didn't have to convert the entire book market to online book buyers. There were still bookstores, by the way, but Amazon, there's actually a Barnes and Noble right near where I live, a big store, and it seems like it's actually doing pretty well. All right. But then you get into other things, music, movies, and eventually anything and everything under the sun. So it's not just a matter of always being unique. It's a matter of selling something in a more functional way. And if the book business was so efficient, they would never have let Amazon enter it. I look at it like E-Trade, the online traders that came around in the late 90s, early 2000s. And you've got Ameritrade, E-Trade, Schwab. Schwab was around since the 70s, but the point is these companies became behemoths, and E-Trade is now owned by Morgan Stanley. But the brokerage industry, if it had been doing such a good job in terms of meeting customer needs, there would never have been room for an E-Trade. So there's always room for an innovator when any industry, is not innovating. And you don't have to be the most original. I mean, buying a stock, what's so original about that? Why do you need an online trader? Well, why do you need an online discount trader that could trade a stock for, $4 commission? Okay. It turned out there was a need for it. So look at the exchange traded funds and look what, ETFs did to the mutual fund industry. So we could go on and on, but I just wanted to make that point. But let's talk about some advice, some conversations that I've had with clients that I think are important, and I think they're important to talk to you about. Okay. And I want to talk about clients who are a little bit, where I'm trying to say this in such a sensitive way. Clients who are just past their retirement, okay, who've accumulated assets, probably, in this case, owning more than one home. And how do you beat the system? I'm not saying there's some magical system, but how do you capitalize on this incredible run in the stock market? We when I was out to lunch with clients last week, as I often am, and I asked them, I said to them, I bet you have more money. I bet you have more money in the stock market than you ever thought was possible. And like, oh yeah, they're also worried about it because it's so much they don't want to give it back. And I did the most simple calculation. I divided what they have by 20, took out a little for inflation, some for taxes. And I said, this is what you have basically for the next 20 years if you run your accounts down to zero. And for people in their 70s, it was enough. It was enough. And that was the reason why we decided to become more conservative. These people are about 55, 60% equities. And I took them down to about 45, 50% equities. only because I still want them in equities and they'll eventually be down to 35, 40%. So the idea was that the way to beat the system is to capitalize on this incredible gain that they've had, this run that we've all enjoyed, and take the money out. Not everybody could do that. I mean, I'm not here to tell you what you can and can't do, but when you're a certain age, high 60s, low 70s, and you've accumulated wealth in the market like the bull market run we're experiencing now, you could beat the system by cashing out. If you're 40, if you're 30, if you're 50, 55, it's harder to beat the system by cashing out because your money could conceivably have to last you 30, 40 years. But when you're 70s, low 70s, your time horizon is a bit shorter. Okay, you're not going to live as long. Longevity risk starts to go down. So the risk of running out of money could also start to go down, and therefore maybe you're in a position where you don't need to take as much risk. Now you could always say if you sold a stock or an exchange traded for whatever you sold an investment, there's only two things that can happen after you sell. Okay, the the first one that can happen is whatever you sell goes up or it goes down. Those are the only two things that can happen. I was just speaking with a friend of mine, Filippo, the other day. He said, I bought some stocks on Monday. I sold them Tuesday. I wish I held till the end of the week. But that's what happens when you make a trade, right? You make a trade, the trade could keep going or it could back off. But if you made a return that you were happy with before you put on the trade, you go home happy. You don't look back. Don't look back. How about learn, but don't look back. Don't beat yourself up. So anyway, for these people who are in their 70s, the idea was you've got enough because of your age. If you were 15, 20 years younger, the advice would be different. You'd still be, probably about 70 to 80% equities, taking more risk. Now we don't know what happens next. The market could tank. Maybe interest rates going up really is the death knell for the stock market. Maybe we're on a 10 or 15 or 20-year period in which interest rates continually rise and a constant headwind for stocks that just seems endless. Or maybe the market keeps going up because the big companies like the Amazons, the Apples of the world, the Googles of the world, maybe they get bigger, they keep getting better, and they just keep going up. And we're all silly to take any gains whatsoever. Maybe. You don't know. And this is why we talk about making personal finance personal again. It's there. Look, there are two kinds of investors, and you have to know, you have to be certain about which kind of investor that you are. And what I mean by that is, are you an investor who's investing based on the stock market? For example, if you're a stock market investor, are you making your sell decisions now because the stock market is up a lot? Well, the market's up a lot. I need to reduce my stock holdings and go into cash, maybe wait for something to drop or maybe wait for the overall market to go down. Are you basing your investments based on what you see happening with the stock market, with the economy, with the macro economic picture, with corporate earnings, the micro picture, the microeconomic picture? What are you looking at? What do you make your decisions based on? Or are you really making your decisions based mostly on your own personal finance? Meaning, hey, let's say you're 30 years old or 40 years old. The stock market could be up a lot. It could tank. It could go down a lot. And you're just saying, you know what? I'm going to keep plowing money into my 401k, into my other brokerage accounts. I'm going to keep buying. I'm going to have some individual stocks. Maybe I'll have some crypto, but I'll have some exchange traded funds and mutual funds and have some really long-term stuff. But I'm making my decisions based on the fact that I'm young, and in 20 or 30 years or 40 years when I need it, that's when I expect things to work out and be a lot higher. And as I get closer to that level, I'll start scaling back my risk, less stocks, less risky assets, more stable assets like, short-term bonds and cash equivalents. That's a personal finance investor, and you have to know which one you are. And I don't think it pays to be both, because I think you're going to be holding two. I don't think it pays to be both, because you'll be holding two opposing viewpoints at the same time. I should sell because the stock market is up too much and it has to go down is one way to look at it. And the other way of looking at it is I need to hold because I'm young enough to absorb volatility, and I'm young enough and I have enough time horizon in front of me to wait for stocks to recover and go back up to new highs, and then new highs and new highs. Which one are you? And I think that's where the biggest mistakes come in. And if you're working with a financial advisor, are you working with a financial advisor whose whose philosophy is based on the stock market? Or is it someone whose philosophy is based on your personal goals? There's such a big difference, and it sounds subtle at first. Well, why are you in the market? To make money. That is the most generalized statement I can think of. I'm in the market to make money. Well, no shit, Sherlock. Of course you're in the market to make money. But that doesn't mean anything. You're in the market to make money. So if you put $100,000 in the stock market and it's worth $102,000, you made money. Get out. Good for you. What if that $100,000 goes up to $1 million, $2 million? If money can double, let's say every 10 years, maybe 12 years, maybe 8 years, maybe 15 years, okay? But if it can double and then double again, you've got yourself some real assets. And with enough time, it could double again. So you've got 3 cycles of doubling. And in the meantime, if you're consistently putting money into the market, that's a pretty good deal. Listen, the stock market has 100+ uptrend that remains undefeated. Do you think at some point you figured out when it's going to crash and when it's going to go down, and those are the times to buy? That's a story for another day. You have to decide what kind of investor you are. Market action based, personal finance based. There's a huge difference. Most of my clients, pretty much my entire clientele actually, is personal finance based. Now, I do know of the clients in my book of business who are sensitive to the gyrations of the market. And that's why my clients are invested based on their time horizon, their risk tolerance, their financial goals. I know those sound very basic and very boring, and you hear those all the time. But it's very easy to get out of the basics and get carried away with something and then get burned because you got away from the basics. The basics is what protects you. The basics are what protect you from yourself. Think about that. Let that sink in. Okay. So now let's talk about a couple of things. Let's take a look at the market. How did the market do? Do a quick share screen, pop myself up in the corner. First of all, I want to show you this. This is the yield curve. You see this here? This is the 2-year. I'm going to make this a little bit bigger so you could see it on your smartphone. Okay. This is the spread, the difference between the 2-year Treasury and the 10-year Treasury. Okay. And it's 1.21%. It was higher earlier this year when the 10-year Treasury was about 1.75. But when that spread, the difference between long-term rates and short-term rates, when that starts to widen, that means the yield curve is getting steeper. And that's what's happening now. Long-term rates are rising. Short-term rates are basically staying planted where they are. The yield curve is going up. It's a vote of confidence that the economy is all of a sudden improving again. So if you remember the beginning of this year, we as investors, the market was really leaning on reopening stocks, economically sensitive stocks, energy, industrials, financials, materials, and pushing out, pushing down consumer staples, healthcare, and technology. Well, and then interest rates went down and technology went up, and the reopening trade basically blew up about a month and a half, 2 months ago. It was over, but it's all of a sudden the last week or two, it's coming back. And now that long-term rates are starting to climb up, they hit 1.5% today for the first time in half a year. They didn't stay at 1.5%, but still in the high 41.4% range. You're starting to get this cyclical trade back in favor with investors. So it's helping banks, it's helping energy, and I'm going to show you those. But if you follow this chart, okay, and you can always let me know you want to follow it, and I'll send you the ticker symbol so you could follow it yourself on you can follow it on CNBC. So that's one thing I want to show you. Okay, let's take a look at U.S. market. So the Dow was up over 200 earlier today. It was only up 71, and it did feel like it was really starting to roll over at the end of the day after a wicked comeback last week. And this is just volatility. Listen, like I always say to you, my day doesn't change day to day because the market is up a lot or down a lot. If your day is changing day to day because of the stock market, you're doing it wrong. I'm telling you, you're doing something wrong. You're not invested properly. You're panic selling. You're panic buying. You're making changes every time the market moves. Look, if you want to make changes, fine. I'm not here to look. I'm not the making changes in your portfolio police. Okay, you're allowed to do whatever you want, but I'm saying you probably have no strategy. You're probably buying high and selling low over and over and over, and it's probably detrimental to your financial health. And every now and then you'll catch a trade and you'll feel good about it, and that'll energize you and keep you going, kind of like a gambler on a cold streak who hits a hot hand and all of a sudden thinks they're a genius again. They're out of their cold streak. But we all know that any gambler over the long term is in a cold streak. Hot streaks, they're just lucky breaks once in a while, right? Feel free to disagree with me in the comments, okay? So the Nasdaq was down 77, and that's because tech stocks are getting hit. Money's moving out of tech back into the reopening trade. S&P 500 is down a little bit, very weighed down by the super mega cap, large cap tech stocks, okay? The 10-year treasury at 1.489. It was a little over 150 before, but no great shakes. Let's take a look at the Russell 2000 small cap. That was up 1.5%. That is a pretty big day. The Russell 2000 for the last week and a half has been on an absolute tear, especially since the middle of last week. It's been moving, and that's a vote of confidence for the U.S. economy. See, that's this one, Russell 2000, Russ 2K. Okay, we've talked about that before. The Russell 2000 is a small cap index that tracks the small cap stocks. It's the index that you need to follow. Okay, everyone follows the Dow Jones Industrial Average, the S&P 500, and the Nasdaq. Just so we get this straight, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference, and I have to disclose that. But the Russell 2000 index is something that you should follow. It's about smaller companies. One stock that I had was Dunkin' Donuts. Dunkin' Brands was in the Russell 2000. Smaller companies with a more domestic revenue base. They are more sensitive to changes and perceived future changes of the U.S. economy. And when you see industrials and financials and energy and then small cap stocks doing well, that is telling you that investors are starting to get pretty build up about cyclical stocks. Okay, so I just want to share that with you. So let's get back to screen one, and we'll pop up the screen share again. Okay, so where do I want to go now? Let's look at crypto. Crypto, you heard the bombshell last week from crypto last Thursday night, Friday morning. China says crypto is out. You're out. It's basically banned business in China. It's banned. You can't transact in it. You can't mine it. You can't buy it. You can't sell it. You can't use it. So it took a hit, and it looked like it was recovering this morning, but still ended down on the day. Down Bitcoin down over 1%. Ethereum down to under 3,000, down over 3%. Litecoin down. Let's see that goofy one. Doge down again, 20 cents. Yeah, it was fun while it lasted. I remember when Elon Musk was touting the Doge and people were like buying it, because of Elon Musk. And I actually put out a clip about how silly I thought that was and how Elon Musk should not tout any Bitcoin. He doesn't know the situation, the financial sense, the sophistication of his audience. As a financial advisor, I have to follow rules, which of things that I'm allowed to say and not allowed to say. You can't use hyperbole, things like that, because I don't know who's going to watch this video and make an important financial decision on something I said. I've got to be careful. And I think anyone with a large audience should take the same amount of care. It's what I think. Feel free to disagree in the comments. Again, we went over bonds, but the 10-year yield is what I'm following. That's the one that was over 1.5. It's 1.48%. And we want the 10-year, in my view, I want the 10-year treasury to go up more. And a lot of people are thinking, why? Look at this news. Fed Chair Powell to warn Congress that inflation pressures could last longer than expected. Well, no surprise there. That's a news flash that just came up by my friend Jeff Cox wrote this over at CNBC. Follow Jeff. He is like the number one big picture markets reporter at CNBC. He's on Twitter. He's on LinkedIn, but he's definitely a lot more active on Twitter, and that's a good place. So at Jeff Cox, CNBC. But we know inflation's up. It'll last longer. I was thinking, I've been talking 2-3 year inflation, but we'll see. We'll just have to see. All right. So what else did I want to talk about today before I let you all go? We didn't talk about the debt limit, but we're going to save the debt limit talk for tomorrow, because I think tomorrow it's going to be a bigger deal in the news, because we're getting closer to a debt. Let me get out of this share screen. The debt limit is just bringing us to the brink of defaulting on U.S. debt and other bills, like you name it, disaster aid, Medicaid, everything that we pay. All right. It's about paying for expenses that have already been incurred. It's not about new expenses. Just so you know, it's like getting your credit card bill and deciding, I don't want to pay. And I know a lot of you would find that attitude abhorrent. Raising the debt limit ceiling is kind of like having a credit card with a $25,000 credit limit, but you need it to go to $30,000. All right. And that's why we need to raise the debt limit. Now, Republicans are saying that they don't want to raise the debt limit because they're worried about profligate spending. But every administration has had profligate spending, and we need to fight over it, like Congress is doing now, which actually I think is a good thing. I know people will, I don't want this and I want that, and people want one or the other. But I think it's important to have the debate that as a nation, how much should we spend on everything? We all should have a say in it. and we can all disagree civilly, we're going to be spending a lot more money. But I do feel that we are more or less coming to the end of the great stimulus surge, which basically started during the Great Recession in 2008 and is just basically continued until now. All right, that's my story. I'm sticking to it. Thanks for sticking with me today. I'll see you tomorrow. If you have any questions, you let me know in the comments. I'll be sure to see them. Please check me out on Instagram at InstaMitchG. That would help me out a lot. Follow there as well. Talk to you soon. Bye.